The Quantum Group USA, LLC in California, DBA Quantum Distribution and Insurance Services. Advisors are responsible for following all insurance, DOL, FINRA, SEC, broker-dealer, and compliance officer approval requirements prior to distributing this information to clients. Welcome back to More Market Insights, a conversation with Andy Moore, Vice President of Advanced Planning and Portfolio Solutions at Quantum. Andy works closely with advisors navigating market volatility, portfolio positioning, and product innovation in a rapidly changing environment, to say the least. So with markets posting an impressive run, the Fed narrative shifting again, and annuity product design evolving alongside interest rates, Andy is here to help us connect the dots on what advisors should be paying attention to right now. So Andy, I guess we start with the markets. We've seen 8 straight up weeks. Earnings,
Crazy.
20% for the second quarter. What the hell is going on? Is this, what I always say, is this sustainable, or is this a house of cards that's going to tumble at some point?
I don't think it's sustainable in the semis right now. Like if you look at the rally, and we talked about it, had to be 2 or 3 episodes ago. Yeah. We talked about the software stocks starting to bear market fourth quarter of last year, and the semis had come down to real key support, and it was either going to break one way or the other. Obviously, semis, there's some of them that have doubled, tripled, quadrupled in the 8 weeks. The Nasdaq's up 30% since the end of March. Most of it is semiconductors, memory stocks. If you even look at the Mag 7, which really carried the market the last 3 years, Apple's at new high, Google's close, but Netflix, Facebook, some of the ones at Amazon really aren't participating. It's been a heck of a run. It almost, if you think about it, the last 2 months, I was looking at some of the charts and just listening to other pundits on the different channels, but it's the biggest run since about 1997,
right.
Maybe the second best in history. It kind of reminds me of the dot-com bubble, but I don't think it's irrational exuberance. When we look at the second quarter earnings, blew away expectations. Up 24 to 30% across the board. Goldman Sachs just raised their outlook to 8,000. Louis Navellier just raised his S&P to 8,200. But what's crazy is we had a 18% run in the Nasdaq. Earnings were up 25, 30%. You actually had forward earnings compression instead of expansion. So markets probably have higher to run in the long run, but we're getting into, we talked about it, midterm election here, summer doldrums. Low volume in the summer can exaggerate moves up and down, but it feels like you need time for a breather. I think maybe it's a buy the rumor, sell the news if we get an Iran deal. Trump seems to be playing games with, I wouldn't say playing games, but his tweets that come out multiple times a day. He says they're close to a deal. What that looks like, I guess, is to be seen.
Is this a taco trade, the Trump always chickens out type of thing, do you think? Or?
Yeah, so I do think, we talked about that last episode,
yeah.
Right? He's going to obliterate, Iran the day we were doing the last recording of this, and of course at the last hour, they don't do anything, have a ceasefire. He's kind of behind the 8 ball going into midterms here.
Yeah.
And when I think about the taco trade, we're so close to maybe just ending the regime. And does that call for a little bit more warfare and bombing and taking more control of the situation, or does he do it through negotiations and another 60-day ceasefire, which I think lends more to Iran than it does the U.S. So is it the taco trade going into midterms? Possibly, probably, but I guess we've got to wait and see. He's the president, and he's smarter than any of us sitting here, so he seems to be the master of the deal, so we'll see what deal comes out of it.
And let's talk about bond markets and inflation. They're kind of center of the discussion again. What are you seeing in fixed income, and how should advisors think about portfolio positioning if inflation is a little bit stickier than we expected?
Yeah, so they always say the bond market is the smartest market in of all markets, even more so than the equity markets, which you have some exuberance going on right now. What surprised me last week is inflation is sticky with oil prices and getting passed down to the consumer. It's hard to unwind that once it gets going. I think the retailers like to charge more for a longer period of time instead of rolling back prices. But when you kind of look at what happened with the fixed income market, we had the 30-year Treasury hit 5.1, which was the highest level since '07. You had the 10-year hit a 4.7 basically, which when you look at the bond market, we had that sell-off last week in the equities, and I think that's what triggered it. It was short-lived after we got a bunch of upgrades on the semiconductor stocks that we just talked about. But the bond market is telling us something that you need to be a little bit worried about. And if the rates have come down about 20 basis points, the 30-year is still over 5, which isn't good for the housing market. But if we can't get the 10-year back under a 4.25%, 4%, and inflation is sticky, that could be the canary in the coal mine. It's not valuations,
Sure.
but it looks to be the bond market, in my opinion.
Let's talk about the folks that have the real power to change things. The Fed, Kevin Warsh is stepping in. They're talking about another rate hike, not lowering rates at some level. So what does that mean for advisors? How do they interpret this kind of changing outlook? And is this something that is really a change in policy?
Well, it's definitely a change in policy because I think a lot of people thought with Kevin Warsh being confirmed, if you'd look back 2 months ago, you'd have thought rate cuts were coming down the road.
A lot of pressure on him to do that.
They thought he was going to be, controlled by Donald Trump. I actually think, he's a really smart guy, and I think he's going to change how the Fed operates in the long run. Hopefully, he doesn't adhere to Trump asking for rate cuts right out of the gate. But you're right, the Fed dot plot, has us with a rate increase by the end of the year, and then maybe a couple of potential rate cuts next year. But that's completely reverse of what we were thinking going into his confirmation. And his first Fed meeting is here in mid-June, coming up in about 2 weeks, 2.5 weeks. So when I look at kind of his goals, his main goal is to unwind the balance sheet. Right?
Yeah.
We've been buying bonds for so long, which I think may have been when he had his confirmation press conference and Trump was there. He talked about that. And if you're going to unwind the balance sheet and you're not buying bonds, that's almost like a quantitative tightening, not an easing. And I think that could have, we just talked about the 10-year going to a 4.7 and the 30-year going to a 5.1. A lot of it had to do, in my opinion, with kind of the bond market, looking at the inflation numbers that were out there. The PPI number was super, super strong last month. We're going to get PCE tomorrow, CPI right after that. But I think he's really behind the 8 ball with what he wants to do. If he's going to let he's going to unwind the balance sheet and let the bonds run off. He needs lower interest rates, and I just think it's hard for him to lower rates right out of the gate and then not be a purchaser of fixed income. I think that's the tug of war that's going on right now.
Well, and on the FIA side too, obviously higher interest rates sort of help the companies that we work with to do things that we don't see very often. Like right now, we're stronger caps, participation rates, a couple of products. You wanted to talk about Augustar and SBL, these bonus products. Talk about how these things are going to change the situation for some clients and some advisors especially.
Yeah, higher rates is definitely good for our industry. It's you refinance your mortgage when rates are lower.
Right.
You refinance your retirement when rates are higher, right? Whether that's a fixed index annuity or readjusting your bond ladder and ripping the coupons off of that. But for us, when it comes to higher rates, you see the carriers looking for that premium, and they readjust pretty quick on the participation rates, the cap rates that we see out there. It's still a benchmark. Benchmarks still rule inside of our space. So the S&P, the NASDAQ, Russell 2000s at new highs, been on a tear. We talked about that a year ago, where we'd be allocating to the Russell. The international EFI is not as strong as it was. That was the number one performing last year. But when we look at how the carriers want to pull that premium in, it's the bonus product still.
Yeah.
Augustar, which a lot of advisors probably haven't heard of them. It's kind of the rebrand of the old Ohio National, but every single one of their indices was up last year. That includes the volatility control, which is unheard of because a lot of them are value plays. But they've got right now a 34% cash bonus. So if we've got S&P was 7,550 this morning,
right.
We'll just say 7,500. that bonus gets you to S&P 10,000, right? They have free partial withdrawals. You can dollar cost average back into some other asset classes down the road. And then you have, with the S&P at 7,500 at SBL, still probably our number one selling bonus product with North American. And the reason the advisors like it so much is because of the 10% free partial of original premium. We had talked about a couple episodes ago, we had one firm that had tens of millions of dollars of the SBL on the books, taking 20% withdrawals and buying Microsofts and Oracles. They came back into the software space, which you and I alluded to for retirees. You thought they go dividend stocks, and here they're buying more growth-oriented inside of their portfolio. So higher interest rates are really good for us. The bonus products, again, when we talk about sequence returns, if you have a retiree that retires this year, right, S&P 7,500, let's just say we do get at 20-30% bear market, that sequence of returns on their 4% withdrawal rate or 5% withdrawal rate, that's what hurts retirement for you. Hopefully they have different asset classes that they can pull that income off of. But again, when we look at how to use the FIA, use the income rider to get to cover all your core expenses, then we at least know all that's covered, less maybe some inflation that we just talked about. Use bonus products to sell asset classes higher, reallocate down the road during bear markets. It's just for a retiree or pre-retiree getting ready to go into retirement. It's probably hard to sell some of these because the market goes straight up, especially the last 8 weeks. But again, let's manage expectations, risk tolerance, things of that nature. And the FIA is a good asset class to look at.
Absolutely.
It's not your grandmom and grandpop's annuity like in the old days.
They have evolved, haven't they?
Yes.
I guess lastly, too, let's talk about the second half of the year. And we just had our interview with Howard Shen from Invesco. We were talking about the midterms and how people panic and worry about that. And really the message overall was basically the midterms typically don't change anything from a market perspective dramatically or even from an economic perspective, but there's usually a pretty big bounce the following year. What should advisors be preparing their clients for in the second half of this year?
Well, the year is definitely not going as any midterm election year. When you look at the second year of a presidential election, typically the toughest. And it started off first quarter was a down quarter, and here we are, we ripped higher second quarter. Do we see that 10-15% correction going into midterms? I still think it's a possibility, especially with the exuberance that we've seen the last 8 weeks. So we had to take a breather and at least that sideways. But to your point, midterms typically don't matter. Who's going to win? Obviously, we've talked about this. If there's a Republican president, right, then Democrats usually take control of House or Senate, and vice versa, right? It's just, politics throughout history have told us that a lot of consumer sentiment aren't happy with the way they're living. And they think if they can change who's controlling the House and Senate, that can change their livelihood, which in all reality it really doesn't. But to answer your question, going into the end of the year, I do think we're seeing higher levels. Yeah. Earnings have just been too robust. AI is driving it. I saw a stat the other day. $800 billion is being spent on the AI infrastructure. That $800 billion is more than most of our G20 GDPs. So that just puts into perspective how much money domestically is going into data centers, new energy facilities, particularly nuclear. Which, if that's the case, AI is probably deflationary. Asset class in the long run. It may drive up, the cost of water and electricity now, but the build out over time should be deflationary. Rotation of jobs, unemployment should be status quo, so to say. But again, going into year end, we're probably seeing higher levels. There's just nothing that I foresee right now unless there's an extension of the war. We talked about before, oil today was down under $90. When we talked about it, we were, pundits were saying oil 150, 200, and I saw a path to 60 or below. Sure. The breakdown in technical on the oil today has it pointed right to $60 in my opinion. So if that happens, we'll see how fast gas stations are to lower the price at the pump. probably won't be real quick. They raise it quicker than it comes down, but at the end of the year, I do think we're higher based on what's going on right now.
Well, you see why we call Andy the Oracle of Scottsdale. Andy, thank you so much for this conversation, which we have on a monthly basis. Sometimes it happens a little bit more often, depending on what the markets are doing. You're pretty busy. You seem like you've got a lot on your plate. Do you want people to give you a call and ask questions, or do you have time for any of that? Because this is really compelling.
Yeah, they can call. I got a text at 4:30, 4:45 this morning from an advisor asking about some of the new technology we're rolling out. We've got a sales summit here coming up on Friday, led by Parker Holland. We've got new software Jason Sanger built through WBC, which is proprietary to us, that he's going to be talking about. But yeah, always available. It may take me a little bit to get back to you. I try to do it the same day, unless it's late in the day. It'll be first thing next morning, but always here to talk, whether it's just markets or conceptually product, asset allocation, whatever it may be. Feel free to give me a call.
All right. Well, Andy, thanks again. This is More Market Insights. We'll see you next time. Thanks for watching.